Dr.D.Kiruthika, Department of Commerce with Computer Applications, Dr. S. Rajalakshmi College of Arts and Science. A warm welcome to my YouTube channel, Learn to Win. Today we are going to discuss about the next series regarding your financial management, that is financial ratio analysis. Financial ratio analysis helps us as a tool to evaluate the organization's financial performance and the positions by analyzing the relationship between the different financial variables. Say these ratios helps the stakeholders assess the organization's liquidity, solvency, profitability, efficiency, and the overall health. So what are the various ratios which is helpful for us to evaluate this financial performance and the positions? The first one is regarding your liquidity ratios. As you all are able to understand, the liquidity ratio is the term which helps us to meet the short-term obligations and cover the immediate cash needs of the organization. Example, current ratio and quick ratio. The quick ratio is otherwise known as your asset test ratio. The current ratio is the assets divided by the current liabilities. That is known as your current ratio. So the thumb rule of your current ratio is 2:1, and it indicates the organization's ability to pay its short-term liabilities with its short-term assets. And then the next example is regarding your quick ratio. Again, asset test ratio is divided by current liabilities, providing that is current assets minus inventory divided by your current liabilities, providing a more stringent measure of liquidity by excluding the inventory from current assets. Okay, so other than these two ratios, the next, other than your liquidity ratio, the next one is your solvency ratio. So what is solvency ratio? It is the ratio assess the organization's ability to meet the long-term obligations. So liquidity ratios helps us to understand about your short-term ratios, while as the solvency ratio helps us to analyze about your long-term obligations and maintain the financial stability. The examples: debt to equity ratio. So the debt and the equity strengthens your, as you all know, the strengthens about your capital structure. So the total debt divided by your total equity, indicating the proportion of your financing provided by debt relative to equity. Then debt ratio, that is total debt divided by total assets. The base is your assets, okay, measuring the percentage of assets financed by the debt. Then profitability ratios, evaluating the organization's ability to generate profits relative to its revenue, assets, equity, or investments. Example: gross profit margin and net profit margin. So the gross profit divided by total revenue gives your gross profit margin. Net profit, that is your net income or your net profit divided by your total revenue, indicates your net profit margin. Okay. So the next ratio, other than your liquidity and your solvency, the next one is regarding your efficiency ratios. It helps to analyze the organization's effectiveness in utilizing its resources to generate the revenue and manage your assets. Examples: inventory turnover ratio and your return ratios. That is, inventory turnover ratio is nothing but cost of goods sold divided by the average inventory. That indicates the quick inventory is sold or replaced within a particular period. And then one more ratio, that is account receivable turnover ratio. One is your inventory turnover ratio, another one is your account receivable turnover ratio. Okay, so in this, the total credit sales divided by the average account receivable helps us to understand about your account receivable turnover ratio. Then next one is your return ratio. That is, return ratio measures the organization's ability to generate returns for its shareholders or investors. Example: return on investment. Okay. Then return on equity. So as you all know, the return on assets means net income divided by average total assets. Then return on equity, net income divided by the average total equities. Till now, so we have discussed about your liquidity ratio, solvency ratio, efficiency ratio, and return ratio with your examples of your ratio. And the next one is regarding your market value ratios. So here it evaluates the performance and attractiveness to investors in the financial markets. So example here is regarding your price to earnings, P bar E ratio we say that. Another one is your price to book ratio, that is P bar B ratio. Market price per share divided by earning per share, that indicates about your price to earnings. Then market price per share divided by book value per share, that says comparing the market value of the company to its book value as reported by the balance sheet. So this says about the price to book ratio. So these are the various ratios which is importantly used in your financial management to analyze about the short term, long term effectiveness or your market or your efficiency of a particular organization. So these are all the small examples, and the I have discussed only here little bit ratios to understand what is the financial ratios which is helpful for the analyzation of the effectiveness or efficiency of a particular organization. Further, we have more number of ratios which can be used inside the organization, whether it is your short term or your long term or a medium type of your enterprise, can be used efficiently to understand the current financial position of your organization, and you can run your organization very efficiently. So thank you so much for watching my YouTube channel. Please kindly keep in touch. We will further give you more number of videos regarding your financial management, which will be useful for your further studies. Keep in touch and kindly subscribe to my Learn to Win channel to have more videos. Thank you so much.